January 9th was not just another trading day, not a routine correction, not a moment of temporary weakness. Silver fell sharply, and the market reacted. But beneath the price movement, something far more important began to surface. For years, silver followed predictable rules. Supply deficits were ignored, inventories quietly drained, institutional positioning grew increasingly asymmetric. And then, the plunge arrived, not as a collapse of confidence, but as a signal that the old pricing framework may no longer apply. That liquidity, not valuation, is now the dominant force. The price weakness may be masking structural stress rather than resolving it. While headlines focused on the drop, capital moved silently, physical metal shifted hands, and global exchanges revealed numbers few were prepared to explain. What happened on January 9th was not the end of a rally. It may have been the first visible crack in a system under strain. And what follows this moment may redefine how silver is priced, sourced, and controlled for years to come. The real risk is not missing the move. The real risk is misunderstanding what this move actually means, and that question remains unanswered. Welcome to Hidden Currency. This channel exists for those who have lived long enough to understand that markets rarely warn loudly. They whisper, and only once. If you value clarity over noise, if you respect experience more than headlines, and if you still believe careful thinking matters in uncertain times, then consider subscribing, not because it is popular, but because staying informed has always been a form of protection. And take a moment to tell us where you're watching from. New York, London, Dubai, Singapore, or somewhere quietly observing the shift. Because what happened on January 9th is not confined to one market. January 9th, 2026 began like many other trading days. Screens lit up across global financial centers. Traders reviewed overnight data. Analysts studied charts shaped by an extraordinary year. At first, nothing appeared unusual. Then silver slipped below a level many believed would hold. The move was not dramatic in isolation. Prices fell, but without panic. To surface-level observers, it looked like a normal pullback after an exceptional rally. Silver had gained more than 150% in 2025. A correction seemed logical. Financial commentary moved quickly to explain it away. Experienced participants were less convinced. They focused not on the decline itself, but on how it unfolded. Liquidity thinned. Large orders moved prices faster than expected. Bid-ask spreads widened quietly. These were not signs of confidence. They were signs of hesitation. Just 48 hours earlier, silver traded comfortably above $80 per ounce. Momentum felt intact. Sentiment was positive, though restrained. Then support levels weakened with little resistance. Algorithms reacted first. Human traders followed more carefully. What mattered was not how far silver fell, but why buyers hesitated. There was no surge in selling volume, no rush for exits. Instead, participants stepped back, reassessed risk, and waited. This kind of behavior often signals uncertainty rather than fear. Markets driven by uncertainty behave differently than markets driven by conviction. Silver's rise to this point had already challenged long-standing assumptions. 1 year earlier, it traded near $30 per ounce. It was considered slow and unremarkable. Over 12 months, persistent supply deficits, rising industrial demand, and shifting monetary conditions transformed it into a strategic asset. January 9th disrupted the sense of stability that had formed around that transformation. Not because fundamentals changed, but because price action and fundamentals briefly disconnected. Physical inventories remained tight. Industrial demand showed no signs of retreat. Leasing rates stayed elevated, yet the price moved lower. That contradiction raised questions serious investors could not ignore. Was the decline reflecting improved supply or simply reduced leverage in paper markets? Was price still the most reliable signal, or had it become distorted by short-term positioning? Institutions responded cautiously. They did not abandon silver. They adjusted exposure. Leverage was reduced. Risk was rebalanced. Physical holdings were not rushed to market. These actions suggested preparation, not retreat. The broader environment added complexity. Central banks signaled patience without clarity. Inflation persisted. Geopolitical tensions remained unresolved. None of these conditions justified a sudden collapse in silver's long-term outlook. January 9th began to look less like an ending and more like a test of market structure, a test of liquidity, a test of whether traditional pricing mechanisms could function under tightening physical constraints. By the close of the day, prices stabilized, but confidence did not fully return. The calm felt provisional. Questions lingered. Why did the market hesitate? Why did sellers fail to press lower? Why did strength beneath the surface not appear in price? For experienced decision makers, these moments matter. Markets often signal transition quietly before it becomes visible to everyone. January 9th was such a signal. Not a collapse, not a confirmation, but the first clear indication that silver was entering a new phase, one where structure mattered more than momentum. In the days after January 9th, Many observers focused on one question alone: whether silver would continue to fall. Charts were adjusted, short-term targets were revised. Commentary centered on price levels rather than underlying conditions. This response was understandable but incomplete. Serious market participants were looking elsewhere. They understood that price is not always a signal of strength or weakness. Often, it is a signal of stress. And stress does not always appear during rallies. It often appears during quiet pullbacks, when markets pause and reveal their internal balance. Silver's decline on January 9th did not occur in isolation. It occurred after 5 consecutive years of global supply deficits. Year after year, the world consumed more silver than it produced. By 2025, the deficit had become structural rather than cyclical. Mines were not closing because prices were low. They were failing to expand because silver was rarely mined on its own. Most silver came as a byproduct of mining for other metals such as copper, zinc, and gold. This created a natural constraint. Even when silver prices rose sharply, production could not respond quickly. Supply remained slow, inflexible, and dependent on unrelated markets. At the same time, demand was changing in character. Silver was no longer driven primarily by jewelry or investment demand. Industrial use had taken center stage. Solar panels required silver for conductivity. Electric vehicles used more silver than traditional cars. Data centers supporting artificial intelligence systems consumed silver across thousands of components. These demands were not optional. They were embedded in long-term infrastructure planning. This meant something critical. Much of silver demand had become price insensitive. Factories did not stop production because silver was expensive. Governments did not delay energy transitions because silver costs rose. These buyers secured supply, regardless of short-term price movements. When silver dipped on January 9th, industrial buyers did not retreat. They observed quietly. Meanwhile, physical inventories told a different story than prices. Major exchanges reported declining stockpiles. In Asia, inventories fell to levels not seen in nearly a decade. Leasing rates rose, signaling tighter availability of physical metal. Dealers reported longer delivery times. Premiums over spot prices persisted. These were not signs of a market suddenly becoming oversupplied. Yet paper markets told another story. Futures contracts and derivatives reflected uncertainty. Traders reduced leverage. Some funds rotated capital temporarily into cash or short-term instruments, not because they believed silver's long-term case had weakened, but because volatility had increased. Risk management took priority over conviction. This distinction is important. Markets driven by leverage react differently than markets driven by ownership. On January 9th, leverage participants adjusted positions. Long-term holders largely did not. This imbalance caused price movement without reflecting a true shift in underlying demand. In simple terms, silver fell not because people stopped wanting it, but because fewer people were willing to borrow money to trade it aggressively. This is often misunderstood. When leverage leaves a market, prices can decline even while fundamentals improve. The removal of excess speculation can appear negative on charts while strengthening the market's foundation. For experienced investors, this type of decline can be constructive rather than destructive. Another factor added pressure beneath the surface: confidence in pricing mechanisms. For decades, global silver prices were set primarily through paper markets. Futures exchanges established benchmarks used worldwide. Physical supply followed those signals. The system functioned as long as physical metal remained abundant and easily deliverable. By early 2026, that assumption was being questioned. When inventories fall and leasing rates rise, physical markets begin to assert themselves. Price becomes less about trading volume and more about availability. January 9th highlighted this tension. Paper prices fell while physical conditions remained tight. That divergence unsettled institutions that rely on stable pricing frameworks. They began asking difficult questions. What happens if futures prices no longer reflect physical scarcity? What happens if industrial buyers bypass exchanges and secure supply directly? What happens if pricing power shifts away from financial centers toward manufacturing hubs? These questions do not resolve quickly. They create hesitation. Hesitation reduces liquidity. Reduced liquidity increases volatility. January 9th fit this pattern precisely. The decline was not a verdict on silver's future. It was a signal that the market was reassessing how silver should be valued in a changing world. That process is rarely smooth. For young entrepreneurs and business leaders, this moment carried a broader lesson. Markets do not move solely on data. They move on trust in systems. When trust weakens, even temporarily, prices can behave in ways that appear illogical. January 9th exposed a market caught between two realities. One reality was long-term scarcity driven by industrial necessity. The other was short-term uncertainty driven by financial structure. The price decline represented that conflict, not its resolution. And as long as that conflict remained unresolved, silver would not behave like an ordinary commodity. It would behave like a strategic asset in transition. After January 9th, the most revealing development did not appear on price charts. It appeared in research notes, internal briefings, and public forecasts issued by major financial institutions. For seasoned observers, this divergence mattered more than the price decline itself. Institutions rarely disagree loudly unless uncertainty is real. In early 2026, silver forecasts spread across an unusually wide range. Some banks projected moderate stabilization. Others quietly revised long-term targets upward. A few warned of deeper corrections. These were not minor differences of opinion. They reflected fundamentally different interpretations of the same market data. This was significant. Large institutions have access to the same macroeconomic indicators, similar models, and overlapping information networks. When their conclusions diverge sharply, it suggests that the underlying system is entering unfamiliar territory. January 9th acted as a dividing line between old assumptions and emerging realities. One group viewed the price plunge as a traditional correction. They focused on monetary policy, interest rates, and currency strength. From their perspective, tighter financial conditions justified caution. Higher real yields reduced the appeal of non-yielding assets. A stronger dollar pressured commodities. This framework had worked for decades, and they saw no reason to abandon it. Another group saw something different. They focused on supply mechanics rather than macro signals. They studied inventory flows, lease rates, and delivery times. They noticed that physical silver was not returning to the market during price weakness. They observed that industrial buyers were extending contracts rather than waiting for lower prices. For them, January 9th was not evidence of excess. It was evidence of fragility. This disagreement created a rare situation. Like when institutions align, markets move decisively. When they diverge, markets stall, oscillate, and test boundaries. Capital hesitates. Volatility increases without clear direction. January 9th marked the beginning of such a phase. The behavior of institutional capital after the plunge was telling. Rather than exiting silver entirely, many funds adjusted exposure. They reduced short-term leverage while maintaining strategic positions. Some increased allocation to physical holdings while trimming paper exposure. Others shifted from speculative trades to hedged structures. These actions did not reflect loss of confidence. They reflected uncertainty about how risk should be measured. Risk models were struggling to keep pace. Traditional models treated silver as a hybrid asset, partly industrial, partly monetary. But by 2026, that balance had shifted. Industrial demand dominated, and much of it was non-discretionary. This made silver behave less like a cyclical commodity and more like a strategic input. Models built for the old framework produced conflicting signals under the new conditions. Institutions noticed this gap. They also noticed that price discovery remained concentrated in paper markets, even as physical constraints tightened. This created an uncomfortable dependency. If futures markets failed to reflect physical scarcity, institutions risked mispricing exposure. January 9th intensified that concern by showing how quickly prices could move without corresponding changes in physical fundamentals. The response was caution, not retreat. Institutions began watching each other closely. They monitored positioning data, delivery notices, and cross-market flows. They analyzed how price reacted to small shocks rather than large events. This type of behavior is common when markets approach a structural shift but have not yet crossed it. For younger business leaders, this phase is often confusing. Prices appear unstable, expert opinions conflict, narratives compete. Yet beneath this confusion lies valuable information. When institutions disagree, they reveal the boundaries of their understanding. Those boundaries often precede major changes. January 9th did not resolve institutional debate. It amplified it. Some institutions argued that silver's rise had outrun fundamentals. Others countered that fundamentals had outrun pricing mechanisms. This debate was not academic. It influenced capital allocation, hedging strategies, and long-term planning across industries that depended on silver supply. Manufacturers began reassessing inventory strategies. Energy companies reviewed procurement timelines. Technology firms examined component costs under stress scenarios. These decisions were not driven by price alone, but by confidence in supply continuity. At the same time, policy uncertainty added pressure. Central banks signaled patience, but not clarity. Inflation remained persistent. Economic growth slowed unevenly across regions. Governments emphasized strategic resources without outlining clear frameworks for access. This environment made institutional forecasting even more difficult. January 9th exposed a critical reality. The silver market was no longer operating within a single shared narrative. It was operating within multiple competing frameworks. Price reflected the tension between them, not a final judgment. For those accustomed to clear signals, this was uncomfortable. For those accustomed to transition, it was familiar. Markets rarely announce structural change with certainty. They reveal it through disagreement, hesitation, and unexpected reactions. January 9th contained all three. The question was no longer whether silver mattered. The question was which framework would ultimately define its value, and who would adapt in time. By the time markets moved beyond January 9th, one reality became difficult to ignore. Silver was no longer behaving like a typical traded asset. It was behaving like a system under transition. Price volatility continued, but direction mattered less than structure. The market was no longer asking where silver should trade next week. It was asking who controlled access, who bore risk, and who set value when stress appeared. This was the true shift. For decades, silver pricing followed a familiar hierarchy. Paper markets led. Futures exchanges determined benchmarks. Physical supply adjusted afterward. The system worked because physical silver was available in sufficient quantity, and delivery risk was considered minimal. January 9th exposed how fragile that assumption had become. In the weeks that followed, a subtle but important change took place. Large buyers stopped relying solely on spot prices. They negotiated contracts directly. They focused on delivery terms, timelines, and reliability. Premiums became less controversial. Availability became more important than discounts. This behavior did not show up immediately on charts, but it reshaped flows beneath the surface. For industrial users, the logic was simple. A factory shutdown costs far more than paying a higher price for silver. Delays disrupt supply chains, contracts, and reputation. As silver became essential to energy, transportation, and digital infrastructure, procurement strategies shifted from price optimization to supply security. This change altered the balance of power. When buyers prioritize certainty over price, sellers gain leverage. When sellers gain leverage, paper pricing loses authority. January 9th did not complete this transition, but it accelerated it. At the same time, financial participants adapted in different ways. Some funds reduced exposure altogether, unwilling to operate in a market where price signals felt unstable. Others increased focus on physical holdings, viewing them as insulation against structural risk. A third group specialized further, seeking profit in volatility rather than direction. This fragmentation mattered. A market dominated by a single narrative moves smoothly. A market divided among many strategies moves unpredictably. January 9th marked the moment when silver entered the second category. For business leaders and entrepreneurs, this environment demanded a different mindset. Short-term predictions became less useful. Long-term assumptions required reevaluation. The question shifted from, will silver go up, to what happens if access becomes uneven? This distinction is critical in strategic planning. Consider supply chains. Companies dependent on silver began mapping vulnerabilities. They assessed exposure to delays, export restrictions, and inventory shortages. They examined alternatives, only to find that substitution was limited or impractical. Silver's properties were difficult to replicate at scale. This reality reinforced its strategic value. Governments noticed as well. Strategic resource classifications were no longer symbolic. They reflected recognition that certain materials underpinned national competitiveness. January 9th did not create this awareness, but it made it harder to ignore. As these pressures converged, the market entered a phase of adjustment. Prices continued to move, but meaning shifted. Declines no longer implied reduced importance. Rallies no longer guaranteed stability. Each move became a test of how resilient the system truly was. For younger entrepreneurs, this period offered a rare lesson. Markets do not change rules overnight. They change behavior first. January 9th was a behavioral signal. Participants reacted differently based on their role, risk tolerance, and time horizon. Observing those reactions revealed more than price alone ever could. Those who understood this did not rush. They watched how physical inventories responded. They monitored contract structures rather than headlines. They paid attention to who stayed active during volatility and who stepped aside. These details often precede long-term outcomes. By early 2026, one conclusion was clear. Silver was no longer just a commodity trade. It had become a strategic variable. Its price was influenced by forces that extended beyond speculation, beyond monetary policy, and beyond short-term sentiment. January 9th did not answer all questions. It raised better ones. Questions about resilience, about dependency, about the reliability of systems built for a different era. Markets rarely provide clarity immediately after transition begins. They provide signals, and it is up to participants to interpret them. For those willing to look beyond charts, January 9th offered such a signal, not of collapse, not of euphoria, but of a shift that would reward understanding over reaction. And in markets shaped by structural change, the difference often determines who adapts and who is left behind.